Investing can feel like standing at the edge of a vast ocean, with waves of information crashing around you. It's easy to feel overwhelmed, but let's take a moment to wade in together and explore the different types of investments. Think of it as a treasure map, guiding you through the waters of finance to find the right treasures for your future. First up, we have stocks. Stocks are like owning a slice of a company. When you buy a stock, you're purchasing a small piece of that business. If the company does well, so do you. The value of your stock can rise, and you might even receive dividends, which are like little rewards for being a shareholder. But remember, with great potential rewards come risks. The value of stocks can fluctuate wildly based on market conditions, company performance, and even broader economic factors. So while stocks can be thrilling, they can also be a bit of a roller coaster ride. Next, let's dive into bonds. Bonds are often seen as the more stable cousin of stocks. When you buy a bond, you're essentially lending money to a company or government in exchange for periodic interest payments and the return of your principal at maturity. Think of it as a loan you're giving, and in return, you get a promise of regular income. Bonds are generally considered safer than stocks, but they also offer lower potential returns. They can be a great way to balance out the risk in your investment portfolio, providing a steady stream of income while you ride out the ups and downs of the stock market. Now, let's talk about mutual funds. Imagine a big pot of money collected from many investors, which is then managed by a professional fund manager. That's a mutual fund. These funds invest in a diversified portfolio of stocks, bonds, or other securities, allowing you to spread your risk across various investments. This is particularly appealing for new investors who may not have the time or expertise to pick individual stocks or bonds. Mutual funds can be actively managed, where a manager makes decisions on your behalf, or passively managed, where the fund simply tracks a specific index. They're like a buffet of investments, giving you a taste of many different options without having to commit to just one. Then we have exchange-traded funds, or ETFs. ETFs are similar to mutual funds in that they pool money from many investors to buy a diversified portfolio. However, they trade on stock exchanges like individual stocks, which means you can buy and sell them throughout the day. This flexibility can be appealing, especially for those who like to keep a close eye on their investments. ETFs often have lower fees than mutual funds, making them an attractive option for cost-conscious investors. They can track specific indexes, sectors, or even commodities, giving you a wide range of choices to fit your investment strategy. Real estate is another popular investment avenue. Investing in real estate can take many forms, from buying rental properties to investing in real estate investment trusts, REITs. When you invest in physical properties, you're not just buying a building, you're investing in a tangible asset that can appreciate over time. Rental properties can provide a steady stream of income, but they also come with responsibilities like maintenance and tenant management. On the other hand, REITs allow you to invest in real estate without the hassle of being a landlord. They're companies that own, operate, or finance income-producing real estate, and they often pay dividends to investors. Real estate can be a great way to diversify your portfolio and hedge against inflation. Let's not forget about commodities. Commodities are physical goods like gold, silver, oil, and agricultural products. Investing in commodities can be a way to protect your portfolio against inflation or economic downturns. For instance, gold is often seen as a safe haven during turbulent times. You can invest in commodities directly by purchasing the physical goods, or indirectly through commodity-focused ETFs or mutual funds. However, commodities can be volatile and are influenced by various factors, including supply and demand, geopolitical events, and currency fluctuations. So, while they can be a valuable addition to your investment strategy, they require careful consideration. Now, if you're feeling adventurous, you might consider alternative investments. These can include anything from private equity and hedge funds to collectibles like art, wine, or vintage cars. Alternative investments often have a higher risk and require a more significant investment, but they can also offer unique opportunities for growth. They're not as liquid as stocks or bonds, meaning you might not be able to sell them quickly, but they can provide diversification and the potential for high returns. Just remember, with alternatives, it's essential to do your homework and understand what you're getting into. Lastly, let's touch on cash and cash equivalents. These are the safest investments, including savings accounts, money market accounts, and certificates of deposit, CDs. While they offer lower returns compared to other investment types, they provide liquidity and security. Cash investments are perfect for short-term goals or as an emergency fund, ensuring you have quick access to your money when you need it. They may not be the most exciting option, but they play a crucial role in a well-rounded investment strategy. So there you have it, a whirlwind tour of the different types of investments. Each type has its own unique characteristics, risks, and rewards. The key is to find the right mix that aligns with your financial goals, risk tolerance, and time horizon. Remember, investing is a journey, not a sprint. It's about making informed decisions, staying patient, and allowing your investments to grow over time. As you navigate this exciting world, don't hesitate to seek guidance, ask questions, and continue learning. After all, the more you know, the more confident you'll feel as you build your financial future. Happy investing.